This is InvestTalk. Independent thinking, shared success.
Hello, my name is Chris. I'm from New York. Calling in about Bank of America, ticker BAC. I wanted to get your guys' opinion on the stock as well as the banking sector. I currently hold a little more than a half position, so I wanted to see if I should be adding at these levels or be holding. Thank you, and I'll be listening on the podcast. Bye.
All right, looking at Bank of America, and it's rallied like the rest of the market, and the market's into resistance, and so is Bank of America here into the mid 40s. It's above about 47. This is a big resistance zone between 45 and 47. So definitely not the place to be adding. And then the question is, do you even want to add in the first place? Now, the good thing about Bank of America, it's big, its deposit base is sticky. So you don't have to worry about a run of the bank like a lot of the smaller banks, Silicon Valley, et cetera. It's going to remain that way. And it's diversified in its lending, and it also has an investment banking arm, right? So if there's M&A activity, if there's a lot of corporate debt refinancing, like you're getting at the end of this year and into next year, and if they land a bunch of that, then they're going to earn a lot of fees by placing that debt. So there's some tailwinds and some diversity that I like with Bank of America. Now, it's my favorite bank out there. It's not the highest quality bank, but it's kind of in the upper to middle to upper, shall we say, the quality of banks that are out there. So I have no problem with it overall. If you go look at historical profitability, it's not as good as, say, a JP Morgan, but it looks like, let's see what its return equity is right now. It's hanging around 9.5, which is okay for a bank. And that's kind of at the midpoint of where it's been over the past decade or so. So I have no problem with Bank of America. It's just up into resistance, and I would be waiting for a pullback. I probably wouldn't buy it until it dips back into the 30s. Okay. Thanks for the call.
I just had a question for the radio show. I'm John from Mission Viejo. I'm looking at Limbach Holdings, Inc., LMB. I've held that for many years. It just keeps going up, and I don't know when to sell it, or should I put a stop somewhere on the way up, or what do you think of that stock? It seems to just keep going up constantly. It's one of the biggest things I ever made. So anyway, hope I hear this on the radio. Thank you. Bye.
All right, looking at Limbach Holdings, a relatively small business still, or a market cap, 1.4 billion. And this is in the construction and maintenance services for heating, ventilation, air conditioning, and plumbing. So this is the type of business that's doing very well due to the AI data centers. It takes a lot of AC to cool down the equipment and keep those systems running smoothly. And ultimately, that has been a boon for their business. They earned only 66 cents in 2021, but earned $3.60 last year, and supposed to earn $4.12 this year. Now, earnings supposed to be up. That's 14% growth, only 7% growth next year, but both of those estimates are going up. So I like the earnings trends. That's positive. The relative strength is 97, so good relative strength here. Not in any major risk of a major reversal unless they come out with some dire earnings. But last quarter, they were pretty strong for Q1. Revenues up 12%. That was after earlier last year, revenues fell 2% in the second quarter. So, you're getting a reacceleration in growth. You like that. Earnings are up 37%. Now, that's a deceleration from the 69% growth from the quarter before. So that's a bit of a worry, is how much more growth can they get out of just really overall modest revenue growth. Is 32 times earnings too much? Probably, but I would have an out on this. I'd have a stop at least. What I would do too is think about rebalancing. It's overbought in the near term. It's moved from, 65 just about a month ago, now up to 125. So it basically doubled in the past month and a half. I would be looking to at least trim, right? You said this is one of the best ones you've done. Is this over 10% of your portfolio? If it is, I would definitely use this opportunity to bring it down below 10% and start to rein in your risk here, because it is a small cap name. 1.4 billion is still small cap, but I like the business that it's in. It has a relatively clean balance sheet, no long-term debt really. But the free cash flow, about 35 million on a $1.4 billion market cap, that's not a great free cash flow yield. Okay. You're talking a little over 2% there and very modest growth. So at these valuations, I would be trimming and I would have a stop at least on a weekly chart. That's what I'd be looking at here because it is on a long-term uptrend. And it would need a break below, frankly, the 100-day moving average, 100-week moving average, for me to be out of this. That's down at $60, so it's a ways. It's just overbought here, and this is a good time to trim, but I would not be selling it. Now, from time to time, we get questions from our YouTube channel, and this one came in from Derek Johnson. So my son's name is Justin also, and thank you for the podcast. My question is about Pfizer. I understand your point about not chasing the yield, but putting that aside, could you buy Pfizer as a contrarian stock, seeing as though everyone hates it? I currently don't own Pfizer. Well, I generally like the idea of being a contrarian, but that doesn't mean you're always a contrarian. You have to really have a foundation for the basis of why things could turn around. And Pfizer's been in a downtrend, a strong downtrend ever since early 2022. Peaked out around $60 per share. Now we're down around 22. And you're probably looking at that dividend yield of 7.5%. And that looks great. That sounds great. And you're talking about chasing the dividend. And that's exactly what's happening here. Its payout ratio is 121%. It has a lot of debt on its balance sheet, about $60 billion in long-term debt. And they've always had a bit of pre-COVID, they had patent cliff issues, they had growth issues, and that's kind of come back to the forefront. They earned $6.58 back in 2022 on the back of the COVID vaccine, but that's waned dramatically since. They're at $1.84 in 2023, $3.11 last year, and then back down to $3.01 expected this year. So I would not be buying it for the dividend. You could be buying it for maybe the stability of those earnings. If it can stay around $3, then great. But I think the COVID vaccine, it's hurt their brand a little bit. I also think that the pressure from HHS and Trump around drug pricing, it's going to likely weigh on their profitability going forward. So, and then if you look at the chart, there's not really anything that's telling you this is going to turn around. Okay. It's still just hanging around. It's below all the major moving averages. The relative strength is horrible. Any balance just gets sold. And therefore, there's no real fundamental or technical reason to jump in right now. You can watch it. You can find stabilization in their earnings and ultimately their balance sheet, because that's what their cash flow is going to go towards, repairing that balance sheet. And until then, I would stay away from Pfizer. Thanks for the call.
Thank you for watching.
If this video was helpful, please give it a thumbs up and subscribe to catch our upcoming videos.
Hi, this is Scott from Florida. I had a question regarding how to judge the health of dividends and whether a company can sustain it or not. I know a lot of folks go by the dividend payout ratio, but I also wanted to ask about free cash flow to see how you could judge if a dividend is sustainable based on those two criteria. Specifically, I was looking at Pfizer. I know it's been beaten down. And also, I guess, another variable that would enter that equation for Pfizer would be apparently they're supposed to be saving $7 billion over the next couple years. At least that's what they're saying. But yeah, if you could just kind of talk about how to measure the health companies that consistently pay dividends and whether they're able to sustain it. Appreciate all you do, and I'll listen on the podcast.
All right. Well, this is something that is easy for me to speak to because I just have Pfizer up from that last caller. And, this is a company that, it says 7.5% dividend. That is not the issue, right? The issue here is not just that it's paying has a high dividend yield, because high dividend yields in and of themselves aren't automatic no's, right? It can be other reasons, usually confounding factors that bring you to saying that that yield is too high or that yield is likely to be cut. Okay. Now, the first thing that you have to pay attention to is the debt, right? Because when a company has a lot of debt on its balance sheet, it needs to service that. Otherwise, the company goes bye-bye. It does not care about you, the shareholder. It does not care about you, the shareholder. It cares about its bondholders, number one, because they have the highest claim on your assets of the business. And so when a company has a lot of debt, your dividend can easily be cut and will easily be cut to pay those bondholders. And so that's the number one factor you have to watch out for is debt on its balance sheet. When there's no debt and a company pays a dividend, there's a lot of levers that can be pulled, right? You can borrow more money in order to continue to pay out that dividend. And a lot of companies do that over time. And ultimately, that is a road to ruin. It's a road to too much leverage and eventually down the line, maybe it's a decade or two down the line, but that dividend being cut. So you don't want a company taking on debt to pay its dividend. That's where the cash flow goes in. It comes in. And that's what you were talking about is, hey, cash flow, whether that's positive or negative, is it enough to pay the dividend? And that's where not just payout ratio comes in, but cash dividend payout ratio, meaning are they producing enough cash flow in the business to actually pay that dividend? Because when you look at just payout ratio, that's earnings. But as you know, earnings can be manipulated a lot more, and companies don't pay you in earnings. They pay you in cash, okay? And that's why cash flow is so important. So yes, the balance sheet is number one. That's the number one thing you have to consider is how sustainable is that balance sheet? Is their balance sheet highly levered, or do they have a very modest, small amount of debt? Number two is that cash flow. Do they have the consistent money flowing in to pay you, the shareholder? And number three is the cyclicality of their business, the type of business that they might have. Is it a business that ebbs and flows, or is there a strong consistency to it? That's why, when you look at quote unquote blue chip names, you think of Procter and Gamble and Coke and, these big names that, they're not fast growers, but, the business rolls in year after year, kind of no matter what the economy is doing. Now, that doesn't just apply to big $100 billion companies. It can also apply to mid and small caps. There are plenty of smaller names that serve niches, right? That are not cyclical. They're not growing a lot because that niche is small, but they're able to have consistency of their cash flow, consistency of their earnings through the economic cycle. And there's not a lot of worries of disrupting their ultimate business and their business model. That's another factor. It's not just the cyclicality of that business, but is it in the tech space where their leadership can be usurped by a competitor very easily that comes out with a new, more innovative product? Right? You have to look at that as well. So what are the risks to that business over the longer term? Okay, so that's the general framework that you need to unpack whether a dividend is sustainable or not. Now, you probably know by now that we get questions submitted over on our YouTube channel in the comments section. So let's try and answer one of those questions. Now, Lindsay Victoria 89 says, what do you guys think about UnitedHealth after this drop? I can't find anyone who's pricing in the new earnings for this year and next year. They lowered guidance today and had a big drop. Well, this is your classic trying to catch a falling knife. And I'm usually not a big fan of that. Especially when a company has this long runway of a certain business model that's produced a certain level of profitability. And then suddenly something happens in the background that totally unsettles that whole model. Number one is the kind of populist environment that we're in. Okay. It's pretty clear that the Trump administration is trying to shake things up. And there's probably no sector of our economy that probably needs more shaking up than the healthcare industry. We all know, I think we all agree that, the amount of money we spend and the health outcomes that we get aren't commensurate with each other, right? And so something needs to change. Now, there's a lot of ideas of how to fix that, but almost nobody says, let's just keep everything the way it is now. That's the right road, right? It's just more of, do you go down more of a Medicare for all type of track? Do you go to a public option type of track? Or do you go kind of the right-wing way, which is more deregulation and maybe cracking down on some of the drug companies, et cetera, like Trump's looking to do? So there's just a lot that's up in the air. And then you have the assassination of the CEO, and the new leadership comes in and has been saying, hey, we're going to change. We're going to approve more claims, et cetera. And clearly that's not really working out either. That's why it looks like the current leadership is going bye-bye as well. So that's why it's plummeting. That's why it's down 50% from its 52-week high, from its all-time high. And because there's just not a whole lot of clarity of what this business really looks like over the next 5-10 years. Because odds are good that it's not going to look a lot like the last 5 or 10 years, right? So, could you try to catch the falling knife? If you did, we had someone talk to somebody, I think it was just a listener, that said, I bought Pfizer. This is a couple weeks ago. I said, no, you should sell it immediately. This is the market's trying to find an equilibrium here of where UNH should really trade. Did I say Pfizer? I meant UNH. And so this is what I was worried about, was that next leg lower, and that's what you got today. Okay, down 18% on the day. So I would wait at least for it to level out a little bit, find some floor, and to get some dip buyers. But right now the market's still discovering, in a price discovery phase. And until that kind of ends, I would stay away from UnitedHealth. Let's go to a caller right now.
I'm calling about Camtek, ticker CAMT. The semiconductor company based in inspection and metrology, part of the industry, and I believe they're based in Israel. I'd like your opinion on this and a good buy price. Thanks.
All right, looking at CAMT is the symbol. And this is out of Israel, like the caller said, and that's about $3 billion market cap. Now, what do they do? Engage manufacturer of metrology and inspection equipment and software solutions for the semiconductor industry. So it's a semiconductor equipment manufacturer. Earnings this year is supposed to be $3.21. That's up 13% from last year's $2.83. And what I like about this business is that pretty much every year, earnings continue to go up. Now, growth is slowing. 2 quarters ago, revenue was up 40%. This last quarter only up 22%. 2 quarters ago, earnings were up 47%. This latest quarter only 25%. So you're getting some slowing of growth. Now, it's only trading about 23 times earnings. I don't have any issue with that. Its relative strength, though, is only 17. Now, how much of this is to do with the fact that it's an Israeli company? Obviously, there's a lot of geopolitical problems over there, and that would worry me a bit. And analyst estimates for next year are coming down. So what I do like about this company is its profitability. Return equity around 24%. And that's been consistent really since 2018. Pre-COVID, kind of saw right through that. And it has a good balance sheet. Pretty much no long-term debt. It's trading at about, enterprise value around 20. That's not terrible. So I actually kind of like this overall. I like its balance sheet. I like its profitability. I like its growth. It's not trading at an egregious valuation. I think the biggest issue here is the chart. It's been in a downtrend from 140 back in July of last year, all the way to a close today around 68. So it'd be faith that the chart would return to growth. Now, it did retest some major support around around $50 already, and it's bounced since. So as long as it doesn't break 50, I actually am fairly constructive on this pullback, on the profitability, on the valuation. I don't mind it. So I kind of like Camtek, CAMT, but I would have an out below $50 per share, or at least the recent low over a couple months ago. Now let's keep things moving and play another caller question from 888-99 chart.
This is Mike from Maine. I'm just calling to get your opinion on stock symbol DAC. I bought a position a little over 6 months ago. Is this a stock that I should continue to hold, or would it be best to get out? Thanks for your input.
All right, looking at Danaos, DAC is the symbol. It provides international seaborne transportation services to some of the world's largest liner companies. So this is the shipping industry historically is boom or bust. And the reason for that is because when things are good, companies go out there, they see not enough capacity, they see how much their profit they're making on each ship, and they go and they order ships. But guess what? It takes 2, 3, 4 years to build those ships. And by the time they actually hit the water, all those other companies have done the same thing, and they flood the market, and there's an oversupply of ships. And that means that the day rate for the ships go down and profits go down. And so that would be my biggest worry over the longer term, is that up and down nature of their business. Now, currently, profitability, they're still earning $28.06 this year. That's only up 2% from last year of $27.47, but it's an $88 stock. So it's trading at a pretty low multiple. But the free cash flow is negative. Okay. And that would be one worry I would have. It recently turned negative even before the trade war. It turned negative in middle of last year. So it's not something that was just recent. It has a good amount of cash, a little bit of debt, but nothing too crazy. Its dividend is about 4%. I think it's sustainable, at least in the near term, because of that relatively low debt ratio. And longer term, they do have pretty good profitability, pretty good cash flow. So if you already own it, I probably wouldn't be quick to sell it. The technicals are fine. You have a relative strength sitting around 78. So it's in the top quarter of the market over the past year. And even during the recent dip, it bounced back rather quickly. And now it's trading at levels not seen since October. So the relative strength compared to the broader market is pretty good. And you got to like that. So overall, Danaos, it's a small name, $1.7 billion market cap. So understand what your overall exposure to small caps are. And don't be afraid to trim during good times, because these are the type of names that are wildly volatile. And it can, great times can quickly turn into terrible times, because they're generally, once again, a price taker. Whatever the going rate is for their ships and their fleet, they just have to take it. They don't have any ability to change the market dynamics. They can be smart about it. They can not overorder ships at the wrong time, etc. But ultimately, if other companies do that, then that becomes their problem as well. So I would be selling, or at least rebalancing on rips, and then buying on major dips, because you're going to get them. And that's the way this business is.
Don't miss out on critical market updates. Subscribe to the KPP Premium newsletter for weekly insights delivered straight to your inbox.
Now let's touch lastly on the shift out of U.S. assets into foreign assets, mainly by foreign investors. And while the market has bounced back, the U.S. market, and like I said, we're about flat on the year, the dollar is still down about 7% on the year. And so if you're a foreign investor, depending on which currency you're in, right, 7% is the dollar index, you could still be down on the year if you're holding U.S. assets because of that foreign currency translation. So that is what they are now grappling with, is not just a more volatile US market, but a weaker dollar. And therefore, they're slowly marching out of US assets. So if you look at European domiciled ETFs investing in US debt and stocks, so I don't know if you know this, but if you live in a European country, one of the only ways you can gain access to US equities is by buying an ETF that is where the assets are being held by, say, a local bank or a local brokerage firm. You're not buying those assets directly. You're buying an ETF or a mutual fund that is, is owning that. And so there's outflows about 2.5 billion euros during April, the highest level since early 2023. And the same equity ETFs have seen further outflows so far in May as well. And this is a long-term trend that is reversing. And you're seeing the most buying of European assets since 1999. And you're getting a lot of inflows into German government bonds, for example. And this is sustained selling. It's not all at once, but it's consistent. And this is what's being reported by institutional investors and investment banks. The global head of FX research at Deutsche Bank said it has seen significant selling of US dollars from real money investors over the last 3 months. And it's partly valuation, but it's also the communication around tariffs, the confusion and unpredictability around the idea of paying a premium for US assets. When there's kind of such geopolitical and political unrest in the United States, it calls into question the stability of the country, the stability of the rule of law. And that is a big reason why these, at least that they're stating, why these pension managers are pulling out. The chief investment officer of Australia's pension scheme, UniSuper, said last month that they had quite a large exposure to US assets and would be questioning that commitment. Same thing with Danish pension. So it's not just individuals. In a lot of ways, it's big pensions in these countries. And a lot of them are state-owned pensions, right? So there's pressure from government, not just small companies that are making these decisions. Bank of America estimates that if they rebuild the hedges, the dollar from pre-COVID levels, it can mean your investors hedging $2.5 trillion in currency risk of dollar assets. So that's another problem. It is not just the geopolitical uncertainty, but it's also a weaker dollar. Before, you got a double whammy of, hey, asset prices were going up and the dollar was going up. Now you're getting that volatility of the asset, and you're getting now a downtrend in the dollar. And so if you want to keep those assets and you don't want to be hurt by the weaker dollar, you're going to need to hedge out that currency risk. And that is kind of the icing on the cake here. If the dollar was continuing to go up, maybe they could stomach it, but that hasn't been the case. And so I think that's the biggest issue they're having right now and why you're getting those foreign governments selling US assets. Well, I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And if today made you think about your own financial picture, your investments, taxes, retirement, whether it's all really working together, let's talk. We can set up a no-cost portfolio review to help bring more clarity and confidence to your financial picture. Just head over to investtalk.com and click on Portfolio Review. Independent thinking, shared success. This is InvestTalk. Good night.